Well, oil prices remain high, as mentioned, staying close to 3-week highs on rising demand from Asia and the continued conflict between Israel and Hamas in the Middle East. And big names like BP, Chevron, and Shell have all reported their second highest annual profit in a decade on increased production. Let's bring in Kim Fustier, HSBC Oil Gas Research Director, to discuss how to navigate the energy space. Kim, it's good to talk to you today. Are there additional tailwinds here that could push the profits higher, or is this as good as it gets?
Thanks for having me on the show. I think, as always, oil and gas prices will be really key to the sector outlook. If you look at consensus for Brent this year, it's already about $82, which is bang in line with spot prices. So right now, we can't count on earnings upgrades to lift the sector higher. In the near term, we do think oil prices can be supported around current levels or even rise if there's further escalation in the Middle East. That said, let's not forget that OPEC has ample spare capacity, over 5 million barrels a day, and that should cap the upside maybe around $85 or $90. In the second half of the year, in fact, we expect oil prices to slide back under $80 when OPEC and Saudi Arabia bring volumes back to the market. I think I should also mention another downside risk for the sector, which is natural gas prices. Prices in Europe have fallen back to almost normal levels just 2 years after the 2022 energy crisis, and that's really surprised us. Also in the US, natural gas prices have cratered recently because of warm weather. But if you take a step back, in this environment, it's still a very solid macro environment for the oil and gas companies, and they're still able to return a 10% total distribution yield, including dividends and buybacks. Balance sheets are in pretty good shape, so companies are able to absorb short-term macro volatility.
And so, Kim, with that in mind, then, who are your top picks, your top 3 picks here in the oil sector?
The energy sector as a whole is cheap and unloved. And so we would expect the sector to re-rate if the companies are able to demonstrate good performance quarter after quarter. Our top 3 picks are BP, Shell, and Chevron. So for BP and Shell, we think they're good rate of change stories. They've got new leadership teams. BP surprised positively at Q4 results by giving much more visibility and stability in its quarterly buyback program. Shell is also executing better and becoming more consistent. And then Chevron, we think, is a good growth story where its organic growth has been further boosted by the Hess acquisition, and it trades at a decent discount to Exxon.
Kim, the broader narrative within the industry has really been about this transition, or whether, in fact, there will be a significant transition away from fossil fuels. You named BP as one of your picks there. I mean, this is one of those companies that has been more aggressive in that transition into clean energy under previous leadership with Bernard Looney. Is that diversification important as you sort of assess where these companies are going to proceed, at least in the medium term? How significant a headwind or tailwind does that provide?
I think if we take a step back, global oil and gas demand is still growing. We can see that in the statistics. And so despite continued pressure from ESG investors, particularly in Europe, the European majors, including BP and Shell, recognize that. And so they have to strike the right balance, really, between being forward-leaning, investing into clean energy, but also making sure that they've got viable businesses and continuing to invest in oil and gas. And that's exactly why you've seen both BP and Shell tilting back towards growth in oil and gas, at least in the medium term for the next 2, 3, 4 years. And then at the same time, pulling back from renewables, but not abandoning the renewables altogether. Renewables still represent something like 20% of BP's and Shell's capital investment programs. So that is still definitely something that investors need to continue to care about.
And Kim, in terms of both on the supply and demand side here, where do you think that's going to be coming from, especially people still waiting for that China demand to unlock?
I think what we saw last year was probably the last of the post-COVID rebound in oil demand. We can't possibly expect that to happen again in 2024. There is no more pent-up demand that needs to come back from the COVID lockdowns. So I think what we're going to see this year is much more of a steady state on-trend growth in oil demand, we're forecasting 1.3% growth in oil demand, and that can be entirely met by OPEC as well as non-OPEC sources, including US shale, as well as Guyana, Brazil, etc. So as time goes on, it is going to be harder and harder, we think, for OPEC to continue to maintain control over this oil market. They've got 5 million barrels a day of spare capacity on the sidelines that will need to come back at some point in time. And at some point, it will become an overhang.
Kim, finally, I wonder how you assess this pause in approvals of LNG exports coming through from the Biden administration. Certainly a lot of pushback coming from the sector here. But, you know, at least in the short term here, what does that ultimately mean for prices?
Well, the first thing to say is that existing and under construction US LNG projects are not affected. It only affects projects that have applied but not yet received approval. So the near-term impact really on prices is minimal. The US and Qatar are driving a big wave of capacity additions, and the LNG market is going to be oversupplied probably from about 2026 onwards. And so the impact of the ban will very much depend on how long it lasts. A one-year delay is not a game changer, but a longer pause could affect new LNG supplies in the longer term, and then that could tighten the market. It could also damage confidence in US LNG, and it could benefit projects outside of the US, in the Middle East, in Africa, maybe even Russia. From a domestic perspective, let's not forget that LNG exports had a few useful benefits. They made it easier for producers to produce oil from gassy shale formations because that gave gas a place to go. So the longer the ban stays in place, the more you'd expect US gas prices to stay low because they have nowhere to go. That's not great for domestic producers, but it would be good for companies that are able to play the arbitrage between US gas prices and international gas prices.
And we do continue to track that natural gas year to date, down about 38%, continuing to see that pressure. Appreciate you joining us with your insights. Kim Fustier, HSBC Oil Gas Research Director. Thank you so much.
Thanks for having me.